Thank you, Julianne. Appreciate you guys having me here again today. Yeah, I'm Jared Scharf, President and CEO of Desert Gold. We've got a number of initiatives going on right now. Julianne touched on them, so I'll just go ahead and get right into it. So our main listing is on the TSX Venture under the ticker symbol DAU. We also have listings in Frankfurt and the US on the OTCQX. At the moment, we've got 291 million shares fully diluted, 224 non-diluted, 12 million options, and 54 million warrants. The warrant schedule is broken down below for those who want a little bit more detail. Management and board are significant shareholders. That coupled with insiders, I'd say the shareholding is, well over 25%. And then Merck, an institution in the US, owns about 7%. And we have some other smaller Canadian institutions such as Grand Peak Capital, retail brokerage firm Lees Jones Gable, Ross Beatty, a name some of you might be familiar with if you watch the mining space closely. He's the chairman of Pan American Silver and a lifelong mining entrepreneur investor. An African shareholder, Sodanaf International, Lucky Holdings, which is a company affiliated with our chairman, and Elemental Altus Royalty, which was previously Altus, and they merged with Elemental Royalties. So our chairman, Sunny Janda, a longtime shareholder, real estate developer based in Vancouver, his family, and closely related parties own a very significant chunk of the company. I'd say in excess of 20%. I myself, Jared Scharf, I'm the president and CEO. I got involved in the company as a director in 2011, transitioned into the CEO role in 2015, and have been driving pretty much all the major strategy in terms of asset acquisition, development, and steering the company to being solely focused on West Africa. And we'll get into the reasons for that. Don Dudek is a professional geologist. He's a director, but he's also our lead technical director. He has 15 plus years experience in West Africa. He was the senior vice president of exploration for Avian Gold, which had an asset called Tabakoto in the belt where we operate. And they were bought out by Endeavour for $460 million in 2012. He then went on to work with Endeavour for a year plus, leading the feasibility study for the Houndé project in Burkina Faso, which is now one of their marquee assets. Chris Marsh, independent director, background in investment banking and technology. Ousmane Diallo is a new hire. We're actually incredibly pleased to have him. He's a Burkinabe, a geologist, previously worked for Acacia, which was a West African subsidiary of Barrick, along with some other esteemed companies operating in the belt. He's excellent, full-time, based in Bamako. He's in the field with our team as we speak, and he's a huge addition to the team. And then Doug Engdahl, professional geologist, Canadian, based in Western Canada, brings other ideas to the company. So this slide here pretty much tells a story of why we are where we are. This is the Kenieba Inlier, or the Kenieba Window. It's an offshoot of the Birmingham Greenstone Belt, which is an area some of you may know well. This is one of the most prolific gold camps in the world. It straddles the border of Western Mali and Eastern Senegal. In fact, the Falémé River here that you can see in blue demarcates the border between the two countries. There are two major regional shear zones that are related or control the gold deposits in this part of the world. The biggest and most famous one being the Senegal-Mali shear zone, which we've outlined in a gold band here, going from north to south. This shear zone is related to about 25 million ounces, more now, probably 30 plus million ounces of production, reserves, and resources. And some of the largest gold mining companies on the planet have major deposits located here. A secondary structure that dips to the west into the Senegal side is called the Main Transcurrent. And that is about a 15 million ounce camp. And it's related to Endeavour's Sabodala, Gora, Massawa group of deposits, as well as Resolute's Mako mine. These deposits were previously Teranga, and Endeavour acquired Teranga in quite a large transaction. So if we start at the top of the camp, you have Allied Gold's Sadiola mine. It's a 7.3 million ounce deposit. All told, past production between Yatela and Sadiola is production reserves over 15 million ounces. I suspect they'll produce between 200,000 and 300,000 ounces next year. they just raised a significant amount of capital to upgrade their mine, as well as they had some regulatory breakthroughs with the Mali Mines Ministry, which will allow them to update the mill and grow the deposit. And they're also doing a lot of exploration in the area. Moving south along the deposit, or along the belt, excuse me, you have our project. It's a Senegal Mali Shear Zone project. It's 440 square kilometers, making it one of the most significant regional land packages in the belt. We consolidated our first piece of ground here in 2012, license of about 65 square kilometers. We've since been consolidating ground in this area due to its prospectivity, and it's now over 10 licenses, like I said, composing 440 square kilometers. We've got a little over 1.1 million ounces of reserve of resources. It was an initial resource we published about a year and a half ago, but really it's only the beginning for us. The blue sky on this property is huge. We've got 27 gold zones that are all open, that need more work. And of those 27 zones, only 5 of them are incorporated into the existing resource of 1.1 million ounces. There's also some near-term production opportunities, which I'll get into in some more detail as we continue. Moving south along the belt, you've got one of Barrick Gold's flagship assets, Loulo-Gounkoto, of resources and reserves, producing over here. It's one of Barrick Gold's lowest cost producers, which is, pretty consistent with this belt. And then Tabakoto-Sagala, this was where our technical director, Don Dudek, worked previously with Avian, the 2 sister deposits here that are still producing mines. And like I said, that was bought by Endeavour in 2012, and now it's owned and run by a private company called Algon Resources. Moving further south along the belt, you have B2 Gold's flagship asset, Fekola. It's well over 7 million ounces now. It's still open. It's a virtual certainty it's going to get bigger, and production will be in excess of 600,000 ounces this year, I would think, and probably going to continue to grow. On the main transcurrent side of the belt, you've got 4 producing mines, as I mentioned: Sabodala, Gora, Massawa, owned and operated by Endeavour, and Mako's Resolute mine, which is a smaller mine, but still does quite well and produces a lot of gold. So we're in the right area. There's a ton of exploration going on. There's a lot of infrastructure because of all these large commercial mines, and that's a lot of opportunity that we can leverage. So zooming in just a little bit more into our project. This image is a bit technical, so I'll touch on the high level. The backgrounds are analytical signal magnetic. And, the big takeaway here is you can see the vastly different color between the blue on the eastern side and the red on the western side. And this black hatched line is roughly where we've demarcated the location of the Senegal Mali Shear Zone. And essentially what you have are 2 completely different rock packages. On the east, you have sediments, limestones, sandstones, things of that nature. And to the west, you have volcanic rock packages. And there's gold mineralization hosted in all of these rock packages. And, this is a very all the way up to 16,000, where anomaly, which is extremely high. And the yellow dots are between 50 to 200 part per billion gold. The black stars are gold zones that we've discovered, or predecessors have discovered through drilling. And the boxes are intercepts of drilling presented in terms of gold grades over width of drilling. And the big, larger black stars, these zones down here, Gorbasi West, Gorbasi East, Borani East. This is where we have our existing resources that incorporate into that 1.1 million ounce resource. It's a virtual deposits in this part of the world is typically they have a thick oxidized cap on them, and that represents potentially free digging gold, easy recoveries, and low-hanging fruit for the company.
Perfect. Jared, just a short, could you please close your camera because you're lagging, and I think it's just the bandwidth with the camera and the sound. So maybe it's going to ease and make it more smooth. Thank you.
Okay. So yeah, maybe I'll touch on that last point. In this part of the world, a lot of the gold systems, they happen essentially virtually at surface or within a meter or two of surface. And typically there's a fairly significant thick oxidized cap. And that oxidized cap is typically free digging, and the gold can be liberated relatively easily before you get into the primary or the fresh rock. And that's the case all over this property. And so about 4 to 6 months ago, we started looking more seriously at getting into mining. The results were very favorable, quite frankly. And so we initiated a preliminary economic assessment on that mining proposition. And I'll touch on that in a little bit more detail. So the technical study, like I said, was initiated. It'll accomplish two things. We'll be updating the resource, particularly in the area of a new zone we discovered called Gurbasi West North. And as I said, the strategy for this phase one mining is to target oxide and transitional materials. Right now, that's looking right around 200,000 ounces. And in some areas like Barani East, the grade's quite good, nearly 2.5 grams per ton in free digging oxide in this part of the world. We're highly optimistic that that's going to do well and make money. So we finished the drilling for the geotechnical and the metallurgy, and the PEA is ongoing as we speak. And I suspect that we will have one of next year. So just to break that down a little bit more, as I said, this project is comprised of 10 mining licenses. And of those 10 licenses, 9 of them are research and exploration licenses, and one of them is a fully permitted mining license, which is outlined here in this red rectangle. Zoomed into this red rectangle where you have this turquoise outline, this is where the starter pit will be. It's going to be a relatively small pit to start, roughly around 60,000 ounces, but the grades are very good. And the other areas, which are outlined in yellow, are where we have other low-hanging oxide targets that we can incorporate, hopefully, into the mine with a bit more drilling and a bit more work. So, what the goal is here is for a relatively small amount of startup capital to get something into production that could have a drastic impact on the company's profile. We're targeting between 15 to 20,000 ounces of production a year for the first 6 years. And that's assuming that we're only going to mine what we know of is there today. I think the likelihood that we expand our resource base with everything, but with any luck, this could be an area that could be producing gold for 10 plus years. And it will have a significant impact on the company's economics and the profile of the company. So starter pit at this Barani East zone and other resources that we think we can incorporate into the mine with some more drilling and a bit more metallurgical test work and so on to get this thing fast tracking. So like I said, 15 to 20,000 ounces, you can sort of deduce from that the type of highline revenue we're talking about. The mining method we're looking at doing here for the oxide is heap leach mining. The major reasons for that is it's relatively easy to set up and quick. The capital costs of setting it up are inexpensive in comparison to a more traditional sort of milling and mining operation. And more importantly, the OPEX is always significantly lower. So we're looking at hopefully a very low cost mining proposition. And, that'll be covered in detail in the PEA when it comes out. This is just a bit more of a zoomed in view of the initial starter pit at Barani East. But this is where we're going to start. It's where we have some excellent grades. And like I said, open pit starting virtually at going to at Barani East. And as you can see, the oxide is actually quite deep in some areas. You're talking about, over 150 meters. But there is the resource, the gold system continues into the fresh rock. We're going to do some more test work to see if the fresh rock is amenable to heap leach. But if it isn't, you could certainly do a more of a traditional milling. We've done metallurgical testing to that effect, and the recovery rates are, over 90+%. So the oxide just represents an initial phase of mining, and there's plenty more opportunity as we continue to work. The PEA will be also incorporating a secondary pit. which is about 15 kilometers, 1-5, to the southwest of the project in an area called Gorbasi. And particularly at Gorbasi West, there are two sister deposits that lie along strike from one another. This Gorbasi West deposit has a significant oxide zone to it. And the discovery that we made just to the north of it about two seasons ago, Gorbasi West North, has yet to be incorporated into the resource. So as part of the this will represent the material east. So this is a bit of a sort of simplified overview of how heap leach mining works. It's fairly straightforward. You stockpile your ore. There'll be an initial crushing circuit. We may use agglomeration, which essentially just means mixing the ore with some cement. And that's to make sure that the heap doesn't get packed down too densely and affect your recoveries. And then that material gets put onto a heap. It's treated with a cyanide solution, and the gold leaches through in absorption and deportment into recovery. And then ultimately, through an electrowinning and smelting process, we produce gold doré bar, and that can be flown to Bamako, very easily, where it can be exported. And again, that's one of the benefits of being in a highly active existing mining camp. We and December through to July, and then there's a very significant rainy season that goes August sort of through November. And you're somewhat limited in terms of what you can do during the rainy season. But if you do your planning and you build up your infrastructure, then you can operate year round, just like the big boys do, like Barrick and Allied, Endeavor, and so on. So, I think the likelihood of a project yielding a net present value multiple times our market cap is high. An internal rate of return extremely strong, showing a very quick payback period, is also high. So I think the PEA will be a significant catalyst for the company. As well, we have some drill results coming out shortly regarding some exploration work that we also did in the previous season. So yeah, there's lots to look forward to. The gold price is being supportive, and I think this small mine will just be the beginning for us. And I say that because there's so much exploration upside on this property package, and it's such a big package that as long as we're diligent about reinvesting in exploration and development while we're mining, that we could be doing this in this part of the world for a very long time. And any questions? Yeah.
All right. Thank you very much for the presentation. Those are great updates indeed, Jared. The connection was relatively bad, so we missed a few minutes, to be honest. But I think the slides were well done, and the message is quite clear out there. New resource coming, PEA coming, looking at scenarios of production. And this is extremely interesting. Obviously, when we look at the history of the sector, this looks very, very promising. One good point also was at the beginning, the introduction of your board in details. I mean, we can see how serious Desert Gold is getting and going, and the direction is now extremely clear. And I think that you're de-risking this project at a very, very fast pace. And obviously, when the PE will come out, well, then that's going to be another big brick in the wall. That being said, if anyone does have a question, please send in it. We already have a few questions in. First off, general question, and I think that you can expand a bit on it. When can we see production starting of any kind on the project?
Yeah, great question. So right now, as we go through this process, like you said, good analogy, getting project finance groups that specialize in funding small mines and things of that nature through various debt instruments, be it gold loans or royalties, streaming, so on. And assuming we can line the capital up while we're going through this process, this mine will not take long to build. We're talking 4 or 5 months. So with any luck, we could start producing gold in the second half of 2025, which would be perfect timing for us because we could use this year's dry season to finish the commissioning and the construction and start producing gold in the second half of 2025.
That sounds absolutely amazing. What type of how much capital are you looking for about?
So let's say subject to the outcome of the PEA, because that's one of the major
Yep.
things we were addressing in detail. I think a capital requirements of around 15 million US, 1.5, is a good estimate,
Okay,
plus or
perfect.
minus 20%.
Perfect. That can give shareholders a very good idea of what's at stakes here. Second question: how far away are the different pits in your scenario of the PEA?
Okay, yeah, sure.
Because you
Let me
do
pull.
have a big property.
Yeah, but as the crow flies to get from one area to the other, it's actually not that bad. So the starter pit at Barani East, which is where the red circle is here, if you can see my screen.
Yes.
Okay, so if I take my cursor down to the lower left to Gorbasi West in the lower left corner here,
Yeah.
Gorbasi West and Gorbasi West North, that's where the secondary phase will be. So like I said, it's about 15 kilometers. But the thing is, what we're doing in this PEA is the design of the plant and equipment will be entirely modular, meaning we'll be able to move it around the property. And so we would just stack another leach pad here at Gorbasi West, West North, and transport the processing equipment down towards this area. And we don't have to go through anybody else's property. You know, all this land package is contiguous. So it'll be a very easy transition to make.
Okay, perfect. That clears that. In your region, we do see low grade and high grade. Can you expand a little on how high grade 2 grams per ton can sound, or 1 gram per ton even, versus
Yeah,
other sectors, like for example, I don't know, Canada, where mining is more conventional, or even maybe South Africa or so on?
yeah, fair enough. So this, if you look at a bit of detail where we've laid out these mines, you can see the average head grade that these deposits are mining. Anything over 2 grams, you've got yourself a fantastic deposit in this part of the world, assuming we're talking about open pit,
Yep.
not underground mining. And the way that virtually all of these deposits start is they start out as an open pit at or close to surface. And some of them at some point when they go really, really deep will sometimes transition into quasi underground mining. Sadiola is an example of that. But there really isn't a significant underground mining culture in this part of the world because the nature of the deposits are that they're typically almost always amenable to open pit mining, which is not where sometimes you're dealing with much narrower, higher grade sort of structures where you need to be doing more targeted mining. In this part of the world, a lot of the times the minerals are broadly disseminated. You know, you'll have a quartz vein where you've got a higher grade core of minerals, but then there's a halo of lower grade mineralization around it. And because everything just costs less in this part of the world, there's employees, everything from getting a mine permitted, right? You could permit a mine in this part of the world for 1/10 the cost, and it'll take you 1/20th the time that you could in North America. So it tends to be a low cost jurisdiction, and because of the nature of the ore bodies, you can go after minerals that are lower grade. And so, in a heap leach oxide, anything north of a gram in this part of the world will make you money. All other things equal. North of 2 grams, assuming you don't have any metallurgical issues, it's a very good grade.
Perfect. One thing at the beginning that I thought was very interesting is that you brought in lead geo, which is a Burkinabe, and I want you to extend a bit on how a difference is made. I do know that you are on the ground very often and so on. It's not a question of footprint, as you guys
Mm-hmm.
have always been there. But now
Yeah.
having it in a commending position, how does that
Mm-hmm.
changes things at Desert Gold right now?
Sure. Because there's a lot of producing mines in the district, there's some great schools for geology and mining, both in Ouagadougou and in Bamako. There's a lot of really good local talent. But like anything, when you start to go further up the food chain and look for more senior guys who've, worked at, producing mines, who have led exploration teams that have made, significant discoveries that have gone on to be economic mines, that's a smaller pool of individuals that you're going after. And so Ousmane Diallo is one of those individuals who sits in that, top percentile. So and he joined the company because of the project. For an explorationist, it's a dream project to be able to work on. And so we're lucky to have him, and I think he's going to enjoy working with our team and on this project very much. And the last thing I'll say about that is you can do a lot of great work remotely, especially with all the advents of modern technology. But in mining, especially, there's nothing like walking on these structures, looking at them with your own eyes, going through the core with yourself. So having a guy of his experience and his level, full time, in the field with our more junior geological staff is huge. It's huge for us.
One other thing, this is something a little more not touchy, but actually sensitive. Could a company like Desert Gold, hypothetically here, start a small scale production and then actually finance his own exploration, his own way into the feasibility study without going back to market?
That's the entire point right now. Is it's been a challenging market for several years for the exploration business and for juniors. I think that is on the precipice of changing, especially with the gold price. But we have low-hanging fruit that we can convert into significant cash flow, and that will free us up to do a lot of things with that capital, be it reinvest in exploration, reward our shareholders through special dividends. It'll allow us to do a lot of other things. And so, yeah, that is absolutely the intention here, is to minimize dilution going forward.
And in that regard, obviously, you just touched on gold prices. I think we saw it very, very clearly in the Orezone company financials, for example. That is one of the guys that are around you down there, but still small scale, 25,000 tons. And we're starting to see massive profits being generated from operations. How does your deposit compares to them with every deposit being obviously unique, but I mean,
sure,
it is maybe a little more of a comparable toward what you're having than other right now production of 100,000 ounces and so on.
Yeah, so I think it's a fair comparison. I think where they're at, their grade is a bit lower, but their mine life is longer because they've had the resources to build up a larger deposit. But I'm highly optimistic that we can do the same, given how big the land package is and how many other gold zones and systems we have close by. So that would be one of our major goals, which is to extend the mine life, and you do that by growing your resources. So I think it's a fair comparison. I think this PEA, the economics of it, are going to probably surprise the market in comparison to where our market capitalization is, and a good surprise. So I don't know if that answers your question.
Okay, yeah, it does, absolutely. And I think it gives people also an outcome of what could be comparable valuation once in production and so on. And this is not always easy to find in the commodity sector. Jared, I don't know if you do have a few more minutes for us, but our next presentation, our presenter, Mr. Lambert, is a bit late due to technical issues. So would you mind continuing the conversation?
No problem at all. I mean, I think, high level, we definitely hit on the salient points, but this is, maybe one of the things that's worth adding on to is this district that you're looking at right here on this image is been a hotbed of M&A activity for over 15 years.
Yeah.
There have been a dozen plus transactions, some of them in the $1 billion range. For instance, Barrick Gold's acquisition of Randgold, Endeavour's acquisition of Teranga, Endeavour's acquisition of Avian, which is where Don Dudek worked, as well as Allied Gold's acquisition of Sadioli Atella, Managem's acquisition of Boto Diaka from IM Gold, and of course, B2 Gold bought Papillon Resources for over $600 million for the Fekola deposit back when it was a little over 2.5 million ounces. More recently, Fortuna Silver acquired Chessa Resources here, and they're working in that area. And as well, close B2's acquisition of Oklo, which has a deposit about 20 kilometers to the east of Fekola, where you see these cluster of stars here. So typically what happens in this part of the world is once a junior or a smaller company builds up a resource base of a certain quantum or a certain size, they start to become very interesting to the bigger producers in the area that have the balance sheet and the infrastructure to put a 2 to 5 million ounce resource into production, deposit into production. And the quantities of money you need to think about for something that size is, $2 to 300 million to put a deposit that big into production.
Exactly,
And so,
and now that you're touching that, maybe one thing, those 200-300 million, just like your 15 million plus minus rule of thumb here for putting in a small scale production. This is obviously
yeah,
not 100% equity. Most of it is raised through a
yes,
lot of financial instruments.
mm-hmm.
Can you walk
Yep.
us a bit on maybe the three main instruments that a mining company, a junior like you, can use into raising those kind of capital?
Yeah, I mean, I think there's probably more than three
Yeah.
instruments, but a traditional project finance, like a project loan. There are other types of things such as gold loans. In fact, if you look at Hummingbird's most recent press release from a couple of weeks ago, there's a pretty good example of a structured debt instrument that they've used to upgrade their production. And they're based in West Africa. They've got a mine in southern Mali in the Yanfalila district. So royalty, streaming services, gold loans, and also some traditional project finance. I mean, in our case, our paid up capital into this project is well over $20 million since 2015. So a you know a PEA that will be done, and maybe I'll clarify this point. The PEA that we're doing is being done at a feasibility study level of detail. However, we are incorporating some inferred resources into the initial starter pit,
Yeah.
and under the National Instrument 43101, to call something a feasibility study or a pre-feasibility study, you need to have all your resources in at least a measured and indicated category. But in our particular instance, we're talking about mining at surface oxide minerals. And so we have a very high degree of confidence that those inferred resources that form part of the resource will be mineable because they're part of the same gold system. So due to a technicality, we have to call this thing a PEA, but it will be done at a level of planning detail that will allow us to move forward into mining, meaning there won't be another follow-up study. But, once this is done, we'll have everything we need to go into mining.
Perfect. And also in regard of financing cost, when you can have
Mm-hmm.
a high grade project with low cost in kind of
Mm-hmm.
jurisdiction like you are right now, what does that change in terms of financing? Once again, I'm putting a lot of emphasis in on that level because
Yep.
a lot of junior are unable to cross that pond to get on the other side, which is bring
Sure.
just a great project with amazing numbers into
Mm-hmm.
production, and then we wait and wait and wait. The 15 to
Yeah.
20 million or 10 or 12 in that in these waters is a very low number. But again, with the
Yeah.
high margin project that one could maybe expect from comparables that we see in the region, how
Yeah.
much leverage that gives you into choosing the financial instrument and protecting shareholder value?
Yeah. So we're getting quite a lot of interest. To address your cost of capital point, there have been several uh, deals that have been done within the district, and we're seeing costs of capital anywhere between the range of sort of 12 to 15%. And so that's a little bit on the higher side. I think that probably reflects, some of the geopolitical challenges that we've seen in West Africa. But for projects that have such, good margins and relatively low startup costs, low operating costs, the payback on capital is still, very, very good. So, and subject to the outcome of the PEA, this is probably a project that, will have a payback of, probably less than 2 years, to be honest with you. And, when we initiated this study and started really looking at it in details management, gold was 1850 an ounce. And,
Yep.
For us, the project looked good at 1850. The biggest thing that we have to do is make sure we're diligent about exploration so we can extend the mine life and build the resource base. Because this first phase of production, we're talking about mining 200,000 ounces. There's already 1.1 million ounces there. And, there's noise everywhere on the property. So we can't lose sight of the core objective of this company, which is to build a tier one mining camp. And in our mind, that's a camp that can produce 200,000 ounces a year for a minimum of 10 years. That's the threshold when you start to get the big boys significantly interested. And the question is, how do you get there and have the minimum impact from a dilution perspective on your shareholders? And what's the smartest way to do it? And so I think this is a fairly straightforward transition. And, one of the other things I would say is don't underestimate the value of being in a district where things such as permitting happen quickly and not at a costly expense. A lot of the times you see mines and small initiatives delayed in places like North America, be it Nevada, Western Canada, and so on. They can't get the permitting done in a timely manner.
Well, more than that,
and
now some project cannot get permitting dot. So it's
right,
beyond just timeline now. There is a big
right,
risk in a lot of jurisdictions, and for sure, having the regulatory support from the Malian government can impact positively on that. And that being said, well, two more questions on that. So first, we touch PE and so on, but for everyone to understand that when the PE will come out, the
yeah,
PE will not be done at the current price of gold. Is that correct?
no, yeah, that's right. So typically the independent third parties were using a company called Minexcon. They were the authors of our previous 43-101 when we produced our maiden resource. And they usually do a 2 to 3 year trailing average on the gold price. However, in essentially what's called a risk sensitivity analysis, is we will also provide a range of what the project economics look like, but the benchmark will be a 2 to 3 year trailing average. But then we'll show you what the project looks like at the current spot price, and plus or minus as you go along. So you'll get a sense. But yeah,
Perfect.
typically these things are always aired way on the side of caution, which is the right way to go about it.
Exactly, but it's also something that we have to say to make sure that people understand that when the numbers come out, they're not tracking current price of gold for anyone who's maybe less used to commodities,
Yeah,
PAs, and feasibility and so on.
correct.
One more thing that we were asked: how is equipment accessibility on that, either drilling, RC drilling, production facility building, and so on? Is there a big premium? Is there equipment available? How does it go to move equipment in there?
So, I mean, it's the opposite of a big premium. In last season, we drilled all-in cost per meter core for $165 a meter US. That's field support costs, assays, drill contractors, fuel, food for the guys, water, everything. I sit on the board. I'm an independent director of a company with assets in Nevada, and we were looking at some quotations for drilling last year as well. Core all-in costs based on our calculations was almost $600 US. So it's a magnitude of almost 3x. And when you're looking at, be it equipment, supplies, you'll find consistently that this is a low-cost jurisdiction in comparison to virtually anywhere else in the world. And it's one of the things that makes it most attractive. So, part of the PEA, when we source our equipment and do our planning, we'll look at a variety of vendors in terms of who we ultimately choose to use. But so much of a heap leach operation is essentially a big earthworks moving exercise, right? Versus a traditional milling operation.
Yes, and I think that this is something that's going to be reflecting in the financials, obviously, of the
Yeah,
PEA.
for sure.
It is in lithium the equivalent of having brine versus hard rock. We're talking about
Yeah,
energy. We're talking about a lot of financials that are impacted, both soft or hard, as well as obviously access to qualified personnel. And I'm saying that in this regard here. So first
yes.
off, obviously, the type of mining that is done is an easier one, but that doesn't mean that there is not qualified personnel down there. And you start touching it again earlier, but I really want to put the emphasis. We somehow can feel that Mali is out there. It's a little hole. It's somewhere where we as Occidental or Northern or Europeans or Northern Americans, we don't have a lot of light being shined on, and this is why it's great to be able to talk to
Yeah,
you for a long time, as you can do
yeah.
that. So basically, how's the need for insourcing qualified
Mhm.
people, and how can you actually really leverage? You were talking about some
Yeah.
universities down there, some programs, some geology being done. When you do
Yeah.
have a belt that is consistently producing at such a high rate for a very long time, obviously it dribbles down to knowledge.
Of course. Of course. Yeah. No, the sourcing qualified personnel is not an issue in this part of the world. Yeah, and you touched on it. Mali is the if it's not the third largest gold producing country on the African continent by now, it's a virtual tie, being third or fourth. But if you look at their production curve, it's probably overtaken in the last 18 months and now the third largest producer. And then the surrounding countries, Guinea, Burkina, Senegal, this whole area, the Birimian Greenstone Belt, the Kenyaba Inlier, there's 25 plus years of commercial mining going on in this part of the world, and the human resource base that you can source reflects that. And so no, we do not have any issue. For us, we're just trying to attract the best and most competitive people that we can find in this district.
All right. Well, this is great news, obviously, on that side. So, what is the vision of Desert Gold within 5 years or 10 years? Where do you guys see yourself, and what role can you play within Mali,
Mm-hmm.
within the shares, and more specifically, something that we didn't touch yet, but within the community itself? When you are
Mm-hmm.
building mines, when you are hiring people on a grander scale, comes more responsibility with it. So, can you share us a bit of the
Mm-hmm.
vision of Desert Gold in that region?
Yeah. So what I see for the SMSC project as a whole, if you look at the sheer size of it, where it's located, I hope it starts emerging as its own sort of mini regional camp. If you look at Yatela Sadiola, or maybe even a better example is Lulugunkoto, people see a big number like 15 million ounces or so on, but what they don't realize is, there's a half a dozen pits that are clustered within a decently sized regional area that are producing that gold or contributing to that resource base. So ultimately I see the same thing happening with us, where we might have a half a dozen open pits, potentially even more, producing in an area where you have built up infrastructure. In terms of impact of community, well, we already have an impact on the community. We provide supplies for the locals. We use local labor whenever we can, whether that's to build up infrastructure and roads after the rainy season. The way the Mali government structures their small mines is there's a 3% government NSR, but there's also a 1% community NSR. So that's a net smelter royalty that directly impacts the local population. So you know we do everything I can with our limited resources, but as we grow and as we start generating significant cash flow, it'll allow us to just do that.
Well, this is great to hear. I've
And
I've always been a great advocate of those community royalties. I think if they're managed properly, they are really game changer for communities. And without having a great cost to the company, it ensures
mm-hmm,
that communities can take their own decisions without having the main company or the developer to choose what is important or not. And therefore, it makes a really great relationships between both. Again, when it's well managed. So we still have about
mm-hmm,
10 minutes before our next presentation.
mm-hmm,
So I will be asking
mm-hmm.
you just a few. Let's go into a flash session, you and I. So, very quick question, very quick answer. Share price, should it be higher or lower?
Higher.
I would have been surprised if the other sense.
Higher.
Shareholder structure, strong, weak.
Strong.
Shareholder structure, who are you most proud of having on board? That's a trick one.
uh, I mean, probably Ross Beatty.
If we would
Probably
have to
Ross
choose
Beatty.
one. Okay, fair enough.
He's a scary guy if you ever meet him in person.
I
He's
I did. I can concur on your answer here. Most potential of your project would be which zone for you? I think
So
we either
this
lost you or you didn't want to answer,
corridor,
but we didn't
sorry,
hear anything yet, Jared.
no big resources potentially going to come from.
Again, we didn't hear anything. So I think you're voluntarily blocking your mic here, not trying to commit. But that was the
No, no,
easiest
no,
question.
no. No. Can you hear me now?
Yes, we can. Yes.
Hear me?
Yes.
Okay. The Barani East Corridor and Mugiafara South in the lower right. I think these are the biggest zones of alteration, multiple kilometers. And within those zones of alteration, there are gold systems. And it's just about getting more work done.
Alt understood or not understood yet?
Say that last part, please. What's not understood?
The fault system, do you now understand it or is still to be uncovered?
Parts of it. We understand parts of it. We have 40 kilometers of strike from north to south on this property package.
And this is obviously one of the big challenge on that question. How do you keep focus on what needs to be focused, and how do you reduce surrounding noise, which is, by the way, quite often positive in your case?
Sliding scale of priority that goes all the way from target generation to economic deposit. And that's not a quick answer, but that's how we do it.
Okay. And use of AI and new technologies, or good old walking geologists?
Good old walking geologists. But that being said, I think the advent of AI in mining and exploration will grow. But we haven't seen one AI tool make a gold discovery yet.
That's a fair point. People on the ground?
Or contributing process, but not the process. People on the ground all day. Good
Perfect.
people.
Yes. And right on a year, let's say on an annualized, do you have over 20, under 20 on the ground?
Over 20. Yeah.
Okay. Possible production of the project in 2025?
Yes. 15 to 20,000 ounces target.
Okay. Desert Gold still being not acquired within the next 3 years? Possibility or not?
Possibility is low. The work we have to do is the same.
Okay.
If our shareholders get offered something along that journey, that's their decision to make. Management will just make recommendations.
Perfect. Okay. Well, that concludes what we will be calling our first grilling with the CEO session. So thank you for that, Jared. I hope you enjoyed that little lightning session. Yeah, that being said, listen, there's still 4 minutes to go. Just one last thing. How did you ended up accumulating all of that land position that is now obviously seen as a prime location in Mali? And how were you able to grab and put all of that together?
Well, when we acquired the initial piece of ground, which was a central block here of about 60 square kilometers, I had a database of over 500 square kilometers of data: soil geochemistry, termite mound sampling, geophysics, magnetics, some drilling. And so I had a regional perspective in terms of where the hot but very valuable part of the world. It's highly competitive, and so years to consolidate this block. Full disclosure, there's a couple little pieces I'd still like to tack on, but I think we've got all the best stuff in the immediate area. But I'd like to maybe add about another 80 to 100 square kilometers, and I'm working on that.
Well, this is good to hear. That means there's always space to grow. And maybe another question, more tricked. Could a company like Desert Gold, is this something even possible, actually sell a piece of land to another exploration company once you go in production, keep a royalty, or be able to actually diversify your risk on long term?
The opportunity for partnership, joint venture is there, given the regional scale of the property package. We had those discussions several times in the past. We need to make sure that whatever deal we do, that it's worth it for our shareholders.
Perfect. Well, obviously, shareholder preservation is always a key component of good management, and also of management that do have skins in the game. They do understand that a lot differently than management that own under 1 or 2% of the company. In that case, you are working for shareholders, also for your pocket and for everyone around. And this is always important to keep in mind. With the release of a PEA, do you see the opportunity to bring on more institutional investors and really bring the story to another level?
Yes, absolutely. Yeah, I think it's going to be a significant catalyst for the company. And I think it'll show just how much potential there is from only looking at the economics of just a fraction of the project. So yeah, I think it'll.
Well, this is great. Well, Jared, thank you very much for your time. That was double the usual time. So I hope I made it work for you and for any viewers that was out there listening to it. You got an in-depth vision of both Jared's vision of the company, of the project, but also of the country, and a little more details on what's yet to come and an understanding of the numbers that will be coming out. So Jared, thank you very much for your time. It's now 6 o'clock here in Vienna, so I will be giving back moderation to Matthias for the next presentation. Thanks again, Jared.
Okay, thank you, gentlemen. Thanks for having me.